Welcome to a walkthrough of the updated SaaS financial model template from efinancialmodels.com. The model version referred to in this video is the premium model version 8. A link to the template is included in the description below. Before we start, please don't forget to subscribe to our channel. This Excel spreadsheet template assists in preparing a multi-year financial plan for a software as a service subscription business, which sells subscription via its website mainly to B2C consumers. The objective of this model is to prepare a new fundraising for equity capital from new investors. The logic of the spreadsheet is as follows. First, we look into the sources of where new subscribers can come from, the different sources of traffic. We then model the sign-up process from trial users to become a new subscriber. We then model the customer retention by using churn rate assumptions over time to basically project how many subscribers we're going to have at which point in time. We then monetize the subscriber base by offering different subscription plans at different price points, which then result in our revenues. And from this forecast, we then also drive all the costs, direct costs, normal operating expenditures and investments in order to then come up with a comprehensive financial forecast, which results in a 3-statement model and free cash flow forecast from which we can get all the figures we need to understand the financial case of our business proposition. This template works for startups where you start with 0 subscribers at one point, and also for existing businesses. For existing businesses, we have a sheet where you can enter the historical financial results, and you can also enter your existing number of subscribers. Now let's start with the assumptions. To populate our spreadsheet, we start with defining the start date of our forecast. Then this basically drives the whole forecast period. Depending on model version, this model then goes 5 to 10 years out. You will have assumptions for inflation, for price or cost inflation, net working capital and tax rate. Then we start with looking into from where our new users come from. New users are users they sign up, but they have not yet subscribed to your subscription plans. And here we need to define how many new users can we expect per month from which source of traffic. So we have defined here 5 sources of traffic: organic, direct, traffic from paid ads. This is modeled separately and it depends how much ad budget you have available. What's the cost per click, and this basically tells us how many visitors we get, and then we need a conversion rate so that we can model how many new users we can expect to sign up on our website from paid traffic. We also have referrals. Here we have word of mouth and affiliate partners. Word of mouth, this depends on the previous subscribers, so we basically calculate on a monthly basis how many of our existing subscribers or how many new users we can expect from our subscription base based on word of mouth referrals. Referrals from affiliate partners, they depend on the work our affiliate partners are doing. So the question is how many affiliate partners we're going to have and how they are going to grow over time. How many referrals they can bring on average on a monthly basis, and then this gives us new users from affiliate partners over time. And then we add this all up, and then we can get the number of expected new subscribers for our trial offer. In our trial offer, we can then estimate what's the conversion rate from free user to paid user. And we can also enter here in case we have a time lag. In case there is a trial period of a couple of months, we can then see the new users, and here we basically apply the time lag. So what we do is we take this amount of users and then multiply by the conversion rate so that we can model this time lag. For some businesses it's material, for some other businesses it's not a topic. We then look into how our subscribers are going to develop. We start with whatever number our starting number of subscribers is. We calculate the new subscribers we can get. These new subscribers, depending on the contract length, they will either renew on a monthly basis or on a yearly basis. So we have some renewals, but then on the other time, we also have some subscribers which will not renew their subscriptions, and they will basically go away. So this then gives us the projected balance of subscribers going forward. As mentioned, we then have different payment plans. We have monthly or yearly payments. So the question is, what is the split? How many of our subscribers, so subscriptions sold, are going to opt for a monthly plan, and how many of those are going to opt for a yearly plan? And as you can see, this assumption then can also change over time. In order for the subscription model to work, we also need to expect some subscribers to leave. So the question is, how much churn will there be? We analyze this and recalculate for the monthly subscription, but the question is, on an analyzed basis, what is the expected churn rate and how many of the existing subscribers can be retained. Then we need to define the monetization of our subscriber base. We are doing this by offering different price points or different plans. So we can define, for instance, basic, pro, premium, platinum plan. We define what will be the expected breakdown of our subscribers, how many of our subscribers will go to purchase which type of subscription. And as you can see, the split then can also vary over time, as we can maybe also expect to optimize a bit our process and bring more of the basic users to the higher tier subscription plans. We then have different price points. We can set the different prices. We can also enter assumptions for potential discounts depending on the chosen payment plan. And as said, we also will have to define how many of our users are going to pay monthly or yearly. This will then result in the expected subscription payments for our subscription business. For subscription businesses, there is one decision needed when it comes down to your revenues, and this concerns the yearly payments. If somebody pays you upfront for 1 year, the question is, how do you account and how do you record this revenue? Do you record the revenue in the month when the payment was made? Or do you record the revenue on a monthly basis, meaning you take the full amount and then you divide it by 12 and distribute it over the subscription period? And we have the option to do basically both. If you recognize the revenue in the month the payment was received, then basically the revenue will be recorded like this. The first month's recorded and then nothing. It will always be in the month when the subscription has been received. But if we say we want to use deferred revenue recognition, then what we are doing is different. What we are doing is we take the payment and then we divide by 12. You see, we divide by 12 and then we basically recognize 1/12 of the amount received during that time of the subscription duration. And this we go with each month. And as you can see, especially the months later the year, there's a lot of revenue which is not going into year 1, but it's going into year 2. So our template allows you to basically take this effect into account. As you can see that then the revenues are different from the payments received. So there are a lot of prepayments or money is collected, which is then the difference and is then going to be activated on your balance sheet. We then continue our assumptions. Maybe there are other streams of income, so we have foreseen some other sources of income which could be used. We then also have to look into the costs. So we start with the direct costs. These can either be linked to the as a percentage to revenue or as a monthly cost per subscriber, or if it would be a setup cost, it would only affect or triggered by new subscribers. So depending on the assumptions we do here, we then can see that this gives us a different budgets for our expected direct costs. Then what we do is, and for this I have to explain you the structure of our income statement. So the income statement works that we have the revenue, and then what we do is we deduct the direct costs, and then we have one special topic, and these are all the paid ads. Do we treat them as direct costs or we treat them as indirect costs? And also the same for commissions. So what we did is that actually we separated this and we put this between direct costs and operating costs, and we look at it as a special type of direct cost, which is acquisition costs, and we want then to track how much money are we going to spend on acquiring new subscribers. So we believe this is a very accurate way of keeping track of these costs. For this reason, we need then to look through our referral programs. If we have a one-time fee we pay, so it says how much what is the value in terms of our first subscription sold? Is it how much? In this case, it's a percent assumption. We then also have another type of commission we could take into account in case we would offer a lifetime commission. So any subscriber signing up during the life of this customer staying with us, we then would have to pay a certain subscription amount to our affiliate partners, and this template allows you to model this. If you don't use this, you simply set it to 0 and there will be no consequences. This only affects for the referrals from affiliate partners. So we actually look if you have the sources of traffic is only applicable to the number of new users or new subscribers we get from this source of traffic. The paid ads we already explained in the paid ads budgets for the acquisition of new customers. This is basically the input you can find here. The next set of assumptions we need to define are the salary costs, how many employees we are going to hire, at which costs, which will then lead to the employee costs. Then we also need to work through our OPEX budget. We always define what will be the monthly target amount where we want to get to, so that we can then come up with the spending schedule. And what we did to model this is, as you can see, for the first year we take the target and what will be end of the year, the expected OPEX items, and then you can either override it or you can keep it the same. So we assume for year one it's probably the same budget, but over time we are going to increase this. So the way we model this is always a proportional increase to the next target. So if you have a business plan which some growth, then we also assume that these OPEX will have to grow, but only within the range of these defined assumptions. Then what we also need to look into are investments. We either have capital expenditures or we have expenditures for intangible assets such as IP or software development costs, which then become activated on our balance sheet in case we want to use that option. The alternative is, instead of activating software costs on our balance sheet, we could also just expense it in our P&L, and then we have to take them into account in one of our P&L positions. If these items are activated on the balance sheet, they are subject either to depreciation or amortization. And we might also need to think about financing. It's not very likely, but in case there would be some debt facility involved, we could also say how much debt financing we can expect in which year and how it's going to be repaid, and at what interest rate will be the cost of this debt. And then we also need to define what will be our exit valuation. First, we need to define the year of exit. In case this is somewhere in between year 5 to 10, we can change the year here. And we also can define what will be the valuation multiple we're going to use. For instance, let's value the business based on EV/EBITDA. So that means this assumption is active. Let's say it's only 8 times, or let's keep it at 10. And then what we'll do is that basically we will look at how much EBITDA we're going to produce over the next years. We apply the multiple, and this will give us enterprise value. By deducting financial debt, adding cash, we can get then to the expected equity value for our business at that time. As you can see now, if we exit in year 8, then from a levered cash flow perspective, we are only invested up to year 8. So that's when then the exit comes into place. But if we say, okay, it might take a bit longer, we simply change the assumption here, and then we exit in year 10. And then the cash flow pattern is different, and we then also can take this into account in our calculation. Now let's talk about funding assumptions. The model will tell you how much funding is required. This is calculated or based on the forecasted free cash flows, and we take into account also operating losses. And based on all these calculations, we calculate then how much do we need without debt financing and how much funding do we need with debt financing. That would be the levered. And then we have to make an assumption. We have to make an assumption how many funding rounds do we plan to target. And maybe here the best or easiest way to start is actually to start with the scenario that let's only go for one fundraising round. The model will then calculate and tell you how much equity financing is required. And this basically takes into account the minimum funding amount and a cash reserve. The cash reserve you can adjust. You see there is a small difference. So what we can do is we can simply, in this case, normally we use a goal seek. And I would just like to get to a rounded figure. So in that scenario, you need $2.5 million to execute this business plan. And as you can see, mainly the reason is there are some operating losses here, but there is also, if you look at the cash flow statement, there is also some investments required to get started. So this is what the model calculates. Then the other option is to go for two funding rounds, seed and Series A in that case. And then you can see the model will calculate how much funding is required for the phase, for the seed phase, meaning up. You see the Series A is in month 13, so it means we need funding up to month 12. The model will calculate that. And then here again, I'm going to go for rounded figures, and here we go. So 1.1 million, 1.5 million. This is what I need. Or alternatively, I could also go and split the Series A, either move it a bit earlier, move it up, or then also use Series B and C, depending on what my plan is. Then we need to also take into account the consequences on the shareholder structure for these funding rounds. To start with, we assume we have these type of investors. The founders, they basically own the company. Now we take investors on board, so we assume all the money comes from seed investor for the seed round, and for Series A it will come from the investor A series investors. How much equity are we going to give? So here we have the assumptions. We can go and say, okay, we give 30% or we give 20%, depending on that. You see that the pre and post money valuation will adopt. And we can just start with what we think might be our goal, and then we can basically fine-tune our plan further and basically zoom in on this post money valuation. Another way to validate these figures is that we also included a VC valuation method. The VC valuation method has you specify what is the target return on an annual basis an investor wishes to obtain. So depending on what the assumptions you put in here, this return will be influenced in the calculation. Normally it should be 25, 30, 35%. Then we go for the calculations, and basically what we do is this VC valuation works that we take the business valuation we have derived earlier, and basically we take it here in the year of exit. this then gives, we need to take this equity value. And then what we do is we want to know if we have this value by year 10 at time of exit and we require 30% return, then we have to discount it to its present value. So 10 years discounting, how much is the present value at discount at 30%, and then we get here the present value for seed round. This means we discount down to the year 0, basically as of today, because the funding round is in year 0. For Series A, this comes later, that's in year 2. So we do the discounting a bit different, it takes into account less years of discounting, and then that's why the value rises. And by doing this, now we can go back and we can compare, is our post-money valuation in the range what maybe a VC or a business angel would think what the company is worth if let's say he believes in the business plan. If we see that this one is a bit too high, we can say, okay, we want to bring it down, and the way to bring it down would be to give more equity. And then you see with 30%, I'm pretty close to that. So 30% in that case would be, if we argue with this, would be a reasonable starting point. Same here. Again, I'm a bit high, so I have to give more equity. It goes down, maybe 25%. I'm very close. So this is how you can basically work out your funding strategy by using this template. Then what we want to do is to make sense of our business plan or financial plan forecast overall. So for this, we can either go on the executive summary sheet or the detailed summary sheet. The detailed summary sheet also has some columns hidden. You can click here and you can also see the monthly projections for the first year if you want to see the details or not, so you can zoom in or out. And we want to basically double check all the forecast, if that makes sense, especially also the profit margins. This is something we could also compare to other companies, the balance sheet, cash flow. We have basically all the information at hand to look at our financial plan from all different kinds of perspectives. We also have detailed information about how we're going to build up the subscriber base, and also from where these subscribers resulted into, so that we can see which acquisition channels we are most dependent on. We also have the information at hand if our strategy relies on a lot of paid ads, so that we know what budget we need to do, how many subscribers we can get from which budget assumptions. Referrals, new subscribers, as you can see, the assumptions from free user to subscriber is important, so we need to have transparency on what assumption is being used in our business plan. And then also all kinds of details to break down the subscribers from different perspectives. How many are on monthly plan? How many on the yearly plan? How many users we expect from which subscription tier? What are the retention rate, which is the opposite of the churn rate, and etc. We then also can see that in terms of the pricing, in this case that's the same as ARPU, average revenue per user, how this varies, and how this then also what the average then results into. Other tables, they cover topics such as the cost structure, acquisition costs, acquisition costs. We might want to look into the customer acquisition costs. So what we know is from the paid ads, how many dollars did we spend, how many users did we get, so we can calculate what is basically the cost per new user. You can see in the first year it's pretty high, then it goes down. Probably this is, if we want to look the reason for that, it must be in the assumptions. You can see here that we have more budget we're spending, and then also we have higher conversion rates, so this starts then to increase. Customer acquisition costs go down because basically we have higher conversion rate. You see between first year and second year we basically for the same budget, we can convert 2% instead of 1.5%. So customer acquisition costs go down, and if this goes further up, they should go down further, as you can see here. We also have a return on ad spend. So here the question is, we have the paid ad budget. What do we get for that? How much do we spend? How many paid users do we get? What is the average price, subscription price they're going to purchase? We take into account some will purchase the monthly plan, some will purchase the yearly plan. We calculate an average, and then we take into account just their first subscription purpose. And based on that definition, what is the return on ad spend? So you see, we spend $1,000, we only get $220 here. We cannot make our money back. We are dependent that these customers will basically renew, and then over the life of their journey will contribute the money. But as you can see here, over time we maybe can make it work. We actually can get our money back already in the first months of subscription, because here it passes ROAS passes the 100%, depending on our assumptions. But it's worth to think through, if our business model is dependent on paid ads, what is the return on investment when spending on paid ads? Operating costs, and then also the cost structure. There are tables here to better understand the cost structure. What is the resulting profit per user? And as you can see, if there's a ramp up, this might be first loss making until we basically can cover the operating expenses, as we have enough users depending on the plan. We also want to think about customer lifetime value, and then also compare this to customer acquisition cost. This is the customer acquisition costs in the first year, as we have shown above, and then what's the customer lifetime value. And we can see we want as much a difference as we can get, so that there is a good return on our investment. As you can see if I change this to year 4, then customer acquisition costs come down. Also, assumptions for churn rate, retentions, they are different. Maybe pricing could also be different, and then the customer lifetime value can result in what maybe the long-term goal is for the customer lifetime value. We have also splitted customer lifetime value depending on if you look at it for the monthly subscribers or yearly subscribers. But you can see here is that the monthly subscriber have lower customer lifetime value, yearly have higher. On average, it's somewhere in the middle. We also have charts to analyze by when this customer lifetime value is obtained. So in the first year, you see every year the subscription renews, it adds up, taking account the churn and the retention rate. So if we look at the chart, we see that the first year is always the biggest contributor of customer lifetime value, and then it goes down. We do this basically up to 10 years, and then we also have a value attributed for the period from year 11 until infinity, which then also has value, assuming our business keeps operating. Then again, coming back to customer lifetime value versus acquisition cost. So here we have a cost associated. If we look at it from a payback perspective, we look at monthly subscribers, and the payback period here is 4 months. It means the subscriber needs to come and pay us 4 months subscription, and then we get the acquisition costs back. If somebody purchases a yearly subscription, then our economics are much better, because he pays for 12 months upfront. So actually, as soon as he pays, we get the money back. Payback period 0 months in this scenario. On average, because we have assumed quite a large number of yearly subscribers, on average we should actually also even be at 0 months based on this scenario here. If you look at our acquisition cost, we also have we have also 2 referral programs. Now the question is, how does this impact customer lifetime value? We can either look at monthly or yearly subscribers, and also either 10 years or lifetime. If we have a one-time referral fee, you see there's not a bigger difference. It's just the first months we have to pay. In this case, we have assumed 100% of the first month's subscription will be paid as referral fee, or these are our costs. And if we see the impact, the customer lifetime value will be adjusted a bit lower because of that. But let's say we have a different commission scheme. We actually offer to give a lifetime commission. So any affiliate who refers us a customer gets a lifetime commission rate. In this case, the assumption is quite attractive: 30% of the revenues earned forever for those customers. So in that case, this has an impact on customer lifetime value, because now we have an additional direct cost to incur, and this means customer lifetime value now adjusts, and we can see in this chart, you can see again the impact. Another analysis to include is to think about the break-even point. How many subscribers are needed to reach break-even? As you can see here in the business, we are here in year 1, and in year 1 we are not profitable. We are making a loss, as you can see. So we have to be below break-even, and this means this is the difference. We basically would have to charge nearly $900 instead of $80 per month on average. So maybe that's not possible, but then let's look at, okay, we have the price is given, but we have in our first year we expect 709 subscribers. How many subscribers would we need to reach break even in year 1? And then in that case, you see there's a lot of new subscribers needed to reach break even with our budget assumptions. Other parameters, then the calculations go on, and you basically can find here anything which helps you to understand the feasibility of your business case. We look at the overall project and levered IRR of this business proposition, how much funding is required, the average cash on cash yield, multiple, and the payback period for the business case overall. Projected business valuation, uses and sources of funds is basically the summary of what we have gone through before. And then we also look at the investor situation. And another way to look if this business proposition makes sense to investors is actually to look at their profitability. And what we've done here is that we have projected the investor cash flows. We do the calculation. We basically see when does somebody put in money. So seed investors in year 0, Series A investors in year 2. We also calculate the expected IRR based on that. And then here again, we can also see if this proposition makes sense to our investors. In case this detailed summary is indeed too detailed, we also have a condensed version of a summary. This is just a one-pager. And here we just look at the feasibility metrics. And we also, what is included here are some quick scenario adjustment factors. So let's say, what would happen if we spend double the ad budget? So 100% more, how would this impact our IRR? And you can see it moves up. So this indicates that our ad acquisition strategy is profitable, because the more ad we spend, the more customer we can get, and the more profitable our business becomes. However, is the ad cost itself, if there is in danger that this might go up, so how exposed is our business to the ad cost? Let's say this goes up by, also this doubles by 100%. And then we can see here the impact. Does it impact the IRR? Yes, there is a small impact. It basically jumps from 49 to 44%. So there's a small impact on, or there's a bit of risk to, if the paid ad cost would increase, it will affect our profitability. And we can do and run this scenario for all the major factors affecting the financial forecast, and just obtain a quick glimpse of how the financials might react to any change in the scenarios before we go back and then change the assumptions again. Another way to look at is we have here different sheets prepared. The idea here is that they can serve as the basis for copy-pasting something to a slide in PowerPoint when you need to present this. This could help to build your pitch. That would be the idea of this. I hope this walkthrough was useful and that the template can be of valuable help when preparing a next fundraising exercise for a SaaS subscription business. If you liked the video, please give it a thumbs up. Don't forget to subscribe to this channel and visit our website efinancialmodels.com. A link to the model is included in the description below. Thank you for watching.